Hello guys, so we are going through macroeconomics. uh Specifically we'll be tackling national income. So definition of national income. So national income is a measure of the money value of goods and services becoming available to a nation from economic activities. It can also be defined as the total money value of all final goods and services produced by the nationals of a country during some specific period of time, usually a year, and to the total of all incomes earned over the same period of time by the nationals. So there is also the circular flow of income and expenditures. There is an economic model illustrating the flow of payment and receipts between domestic firms and domestic households. The household supplies factor services to the firms. In return, they get factor incomes. With income, they buy goods and services from the firm. So we have to we have household and farms. So when the farm produces the goods and services, the household buy all of it through consumer spending. And when the household sell their services to the farm, they earn through the factor incomes. They sell through factor services and they earn through factor incomes. The point at which the flows from one sector meet the other sector and generate other flows are called critical points. In the above diagram, the critical points are A, B, C. So the A is the factor income, B is the factor services, C is consumer spending. At A, the flow of factor services from the household meet the farm sector and generate the flow of factor incomes from the farm to the household. At B, the flow of factor incomes meet the household sector and generate the flow of consumer spending. At C, the flow of consumer spending meets the farm sector and generate the flow of goods and services. So we have various approaches to measuring national income. So the first one is national output. The second one is we have three aspects: national output, national income, and national expenditure. So those are the three aspects of measuring national income. So the compilation of national income statistics is a very laborious task. The total wealth of a nation has to be added up, and there are millions of nations. Moreover, in order to double check and triple check the statistic, the national income statistician has to work out the figures out in three different ways, each way being based on a different aspect. The three aspects are: A, the national output. This is the creation of wealth by the nation's industry. This is valued at factor cost. So it must not be the same as national income. So the national income is the income of all citizens. C is the national expenditure, because whatever we receive we spend or lend to the banks to invest it, so that the addition of all the expenditure should come to the same as the other two figures. So when you combine national output, it's supposed to be equal to national income, it's supposed to be equal to national expenditure. So we'll be tackling each of these. So we'll start with national income. So using total expenditure for calculating national income. The expenditure approach centers on the component of final demand which generate production. It thus measures GDP as the total sum of expenditure on final goods and services produced in an economy. It includes all consumers' expenditure on goods and services except for the purchases of new houses, which is included in gross fixed capital formulation. Secondly, we included all general government final consumption. This includes all current expenditure by central and local government on goods and services, including wages and salaries of government employees. To this, we add gross fixed capital formation or expenditure on fixed assets to bracket building machinery vehicles, either for replacing or adding to the stock of existing fixed asset. This is a major part of investment which take place in the economy. In addition, where the value of physical increases in the stocks or inventories during the course of the year. The total of all these give us total domestic expenditure into bracket TDE. We then add expenditure on export to the TDE and arrive at a measure known as total final expenditure. So called because it represents the total of all spending on final goods. However, much of the final expenditure is on imported goods, and we therefore subtract spending on imports. Having done this, while we arrive at a measure known as gross domestic product at market prices. To gross domestic product at market price, we subtract the taxes on expenditure levied by the government and add on the amount of subsidy. When this has been done, we arrive at a figure known as gross domestic product at factor cost. National income, however, is affected by rent, profit, interest, and dividends paid to or received from overseas. This is added to the GDP as net property income from abroad. This figure may be either positive or negative. When this has been taken into account, we arrive at the gross national product at factor cost. As production takes place, the capital stock of a country's warehouse, part of the gross fixed capital formation is therefore to replace owned capital and is referred to as capital consumption. When this has been subtracted, we arrive at a figure known as the net national product. Thus summarizing the above, we can say Y is equals to C plus I plus G plus to bracket X minus M. So Y is the national income, C is the consumption, plus I is the investment, plus G is the government expenditure, plus minus X minus M. X is exports, M is imports. So the second way is the using factor incomes for calculating national income. So this is a second method, is to sum up all the income to individuals in the form of wages, rents, interest, and profit to get domestic incomes. This is because each time something is produced and sold, someone obtains income from producing it. It follows if we add up all incomes, we should get the value of total expenditure or output. Incomes earned for purposes other than rewards for producing goods and services are ignored. Such incomes are gifts, unemployment, or relief benefits, lottery, pensions, grants for students, etc. These payments are known as transfer income into bracket payments, and including them will lead to double counting. The test for inclusion in the national income calculation is therefore that there should be a quid pro quo, that the money should have been paid against the exchange of a good or services. Alternatively, we can say that there should be a real flow in the opposite direction to the money flow. We must also include income obtained from subsistence output. This is the opposite case from transfer payment, since there is a flow of real goods and services but no corresponding money flow. It becomes necessary to input value for the income that would have been received. Similarly, workers may, in addition to cash income, receive income in kind. If employees are provided with rent-free housing, the rent which would have been to pay for those housing on the open market should in principle be imputed as part of the income from employment. The sum of this income gives gross domestic product (GDP). This includes incomes earned by foreigners at home and excludes income earned by nationals abroad. Thus, to gross domestic income, we add net property income from abroad. This gives gross national income. From this, we deduct depreciation to give a net national income. So the NB, the residual area, is a small error to bracket about 1% in the collection of these figures. So there is also a third option which we will go through, using the national output for calculating national income. So the output method of the value added approach, which will take it on in the next episode. Please subscribe, like, and comment. If you have any thoughts on this, share it with us at the comment section. Please share it with your friends and family. Adios.